Oh my God, folks, we need to talk about this today. The ridiculous 6.5% dividend yield that Bank of Nova Scotia is currently offering. They just dropped their earnings. We're going to discuss that along with this 20 plus year high yield that I have been gobbling up. As many of you know, about a month and a half ago, I basically made my own miniature ETF in the Canadian banking sector. I upper weighted the two best performing banks, being Royal Bank and Toronto Dominion, putting about 12,000 between the two of them. And then the lackluster performing banks, CM, Bank of Nova Scotia. Actually, National hasn't been the worst performer. Actually, it's one of the better performing banks, but because they're lower market cap, I figured I'd lower weight them, putting about 9,000 between these three banks. But I'm trying to build a dividend portfolio in Canada, and I'm starting with the Canadian banks within my corporation. So these are all in my corporate account, and I'm going to be paying out these dividends to my personal name in perpetuity into the future. So I want to continue to scale this for a passive income portfolio. And at this point, I've got about 12% of my entire current stock portfolio sitting within these Canadian bank stocks. I'm not looking to buy any more here. I feel like I picked them up at a fairly favorable price, and I just want to see how they perform moving forward in the next 3, 5, and 10 years. I'm not looking to sell them or pretty much change the positions in any manner. I'll use the dividends to pay myself out and retop up my tax-free savings account after a real estate purchase, and I'll use new capital that gets injected into the business from my operations to continue to buy other Canadian dividend stocks. But Bank of Nova Scotia is a bank that I've been using pretty much since I've been like 15 or 16 years old, probably even younger for that matter. It was the first account I ever opened that I still use, and I have money in their high interest savings accounts. In my emergency fund, I've got an extra 5,000 here sitting at 2.65%. I have another 5,000 aside for tax liabilities at about a little higher than I think 2.65, maybe around the same, give or take. I'd have to double check that account, but I'm really comfortable with these yields. I know you can get higher elsewhere, but this is, at a moment's notice, I have access to this in case something comes up where I need the emergency funds, and then I have money in my regular savings as well. But I like getting options to these higher interest rated accounts. Bank of Nova Scotia right now, guys, has been popping up after their recent earnings, and currently the yield is sitting at about 6.6%. We're not talking about a massive rally after earnings. It's only up about 4.5%, 5%. The stock is still trading down wickedly from its recent highs. It's down like 30%, which is just astounding, kind of getting back into the pandemic level area. On the max chart, it doesn't look so bad if you go back to the early 2000s, but I mean, when it peaked during the 2008 financial crisis, I mean, it's only trading up 20%. I mean, this thing has wiped out 5 years of capital gains, but the dividends are what we're primarily focused on, because I don't think this bank is going to go bankrupt anytime soon. I think it's trading at a very favorable level here, and to lock in a 6.5% yield, I can't explain to you how insane this really is, because when you take a look at the historical dividend yield at 6.5 points, the last time it got even close to these levels was during the pandemic, the flash crash of 2020. But basically over its 25 year history, it's never actually paid out that high of a yield. This is an incredible place to cost average into this if it's a stock that interests you. I'm not offering financial advice by any metric, and if you don't want to take on the risk of owning the banks individually, you obviously can lock in guaranteed investment certificates right now that on a 2-year are yielding 5.4%, or basically, double of what my high interest savings accounts are paying. And these yields are really incredible. If they continue to raise interest rates and we don't end up petering off soon, eventually you're going to get pretty close to a full market return, just putting money in GICs. And at that point, I think it becomes fairly favorable. But it's that balancing act of, is the guaranteed 5 to maybe 7% return more favorable than the discounted value and the potential capital gain upside of owning these banks individually? And right now, I'm still on the side of just owning the banks. Now, from the dividend standpoint, this company isn't nearly as resilient as something like TD or Royal Bank, in my opinion. Their dividend's only gone from 60 cents 10 years ago to about $1.06. They haven't done an exact double, but considering how high the starting yield is, even if they can raise the dividend by 50% in the next 10 years, I mean, I wouldn't be complaining, because that would easily, get you closer to 9-10% yield on cost. And I still think over time, as the economy grows and population grows and they're operating in growth markets, that the dividend growth should probably continue to be in line to some varying degrees. But talking about the earnings first and foremost here, total revenues hit about $8 billion, which almost 8.1, which is up slightly from the 7.8 this time last year. So like all the other banks, this one is growing, just not at the same rate as something like, Royal Bank or Toronto Dominion's been growing. Total, loan loss provisions here. Again, this is what's hindering all the banks. I mean, to see that net income drop down to 2.2 billion versus 2.5, 2.6 this time last year is very unappealing, considering they've increased loan loss provisions by doubling over this time last year in the concern of these shaky loans. Right, taking a look at the different sectors, this bank gives you more exposure to Latin America, and we'll talk about some of their exposure in these markets that I would consider to be better growth markets, considering which we'll take a look at GDP on these countries. But first and foremost, the Canadian banking net income was down 12%, but the revenues were up 3%. On global wealth management, again, net income down. Net income is going to be down across the board because of loan losses, but the revenue continues to grow. It was up 2%. You look at the global banking markets, and the revenue was up a whopping 17%, and the net income was up 15%. So we're seeing the vast majority of Bank of Nova Scotia's growth really be leveraged on the global side of things. International banking, the revenues were up 8%, which is very nice to see. Again, net income down, obviously. But nonetheless, it's kind of surprising to me because I thought that would have been the hindering part of their portfolio, that, in these tougher markets, that perhaps Latin America and the countries they operate in would be more shakier than the US and Canada. But that's proving not actually to be true. Taking a look at the gross impaired loans, these obviously have been inclining, but are still very nominal. And they're saying that these aren't actually worse than it was during the pandemic. That they're saying that their assets are actually fairly resilient in this kind of market environment, which is why I'm stating, depending on what the next year looks like, it's very likely we're going to see a soft landing. And even if we don't see a very soft landing, and there seems to be a higher hindrance to impaired loans, that I think a lot of it's been priced into the stock at this point, because I'm not expecting a catastrophe in the market here, folks. And you take a look at their global markets, again, that's where all the growth is coming from. And we can see from a GDP standpoint, this is very intriguing to me. So look at the full year here. We can see all the real growth right now is in Chile, it's in Peru, it's in Colombia, and they're seeing that growth on their actual income, right? Their revenues. It's kind of mind-blowing to me that I really would have thought there would have been more growth in Canada and the US, but there's not. So Bank of Nova Scotia, it's probably a healthy thing to get diversification, whereas, Royal Bank is purely in Canada. Love it. Canada's growing great. They're getting benefit from that. Toronto Dominion's giving some U.S. exposure, which has caused some, controversy with how shaky the U.S. markets have been on the regional banks, especially with their attempted acquiring of First Horizon that didn't work out. But still, this is actually fairly bullish from a diversification standpoint, right? And obviously, the digital systems are taking over still. I mentioned this with all the banks. We're talking about continued growth here. It looks like 61% of digital adoption. I do all online banking. I cash all my checks online. Brick and mortar are going to start to deteriorate. I know people that work at the bank, friends, and they told me that really it's only old people looking to move around a bit of cash. And there's places like, I think LA right now wants to completely abolish cash for businesses because it's safer for them from a robbery standpoint. It lowers costs. I know a lot of people are still for the cash realm of things, but I honestly like the digitization of money because I'm not trying to hide anything, right? I believe resilience and growth and true entrepreneurship. If you want to have any assets and borrow money from the bank, you need to show income, right? So I don't like hiding anything. I don't like working for cash. There's other ways to get tax benefits out of the market, but still, the digital adoption age is here for the banking system, which I think, again, is going to deteriorate brick and mortar for them. Outside of that, the last thing I want to touch on is the Canadian residential mortgages. This is something that, again, comes into big concern if they don't lower interest rates. This is where the catastrophe of what people think are going to happen in the future is going to come from, because right now there's really not that much money between this year and next year. 2024, I think we're taking a look at a total of $34 billion in renewals for maturity scheduling, but the real reality hits hard if interest rates stay up into 2025 and 2026. I have a very wide intuition here that they're going to cut rates sometime by summer or spring of next year, presuming because it's all for inflation. It's all because of inflation. The bank, the Treasury in Canada, their job isn't to control mortgages or the stock market. Their pure job is to control inflation. So when it gets under control and it nominalizes, they will slowly and even rapidly, if the economy breaks, which I don't think it will, but they will start cutting them at some point. I'm almost sure of it. And so long as they start cutting them before 2025 2025 and 2026, I don't know how low we'll go, but something tells me they'll become more in line with inflation, which will be probably around 3 or 4% at a nominal rate. That shouldn't really implode the real estate market, even though the real estate market has been handling these interest rates pretty well as it stands in this moment. But again, look at the 63 billion and then 95 billion. So a huge percentage of loans between 2025 and 2026 come up for renewal. And again, it's a waiting game until then to see how hard interest rates can affect those. But at this point, I love Bank of Nova Scotia, guys. I love these banks in general. I think upperweighting the big banks is going to benefit me greatly from a performance and growth standpoint, and from a dividend standpoint, diversifying the lower banks is going to continue to yield really great income. I'm really excited to see the performance of my banking sector as I start to look forward to other aspects of the market when it comes to utilities and the Canadian national railway systems, and start really rebuilding a portfolio after I personally purchased real estate in one of the worst markets imaginable. Apparently, I mean, it's working for us just fine, but I'll pass that question off to you. I'd love to know what you think in that comment section below.